Good afternoon, ladies and gentlemen. This is Niranjan, President Secretary General, BCIC, welcoming you, for people who have logged online and also for people who are there in the room. It gives me great pleasure in terms of introducing our speakers today. Before I do that, let me welcome you to the session on latest development in international trade finance, organized under the aegis of International Business Expert Committee, headed by Chairman K. Ravi and then Co-Chairman Mr. Ganesh Shenoy. Today's event is sponsored by South Indian Bank, and I would like to acknowledge the presence of Ms. Kamala Kumari, AGM, Mr. Sachin Joseph and team from South Indian Bank. And I also take this opportunity to acknowledge our annual sponsors, Bueller, Fundermax, IAMPL, MTR, Sona, SDM IMD, TVS, Vishwas, and Wipro Group. So before we start the session, we would like to play the corporate video of BCIC. Once the corporate video is over, I'll hand it over to Mr. Ravi to initiate the session. Corporate video, Mr. Purushottam. Thank you. We have with us two speakers today, Mr. Somasekhar, expert in international finance, and Mr. Radhakrishnan, head international business division, South Indian Bank, with us. Thanks for being with us, sir.
Thank you.
And then I now hand it over to Mr. Ravi to take it over from here. Over to you, Mr. Ravi.
Very good evening to all of you. I think, first of all, let me introduce the speakers for today. We have, as you all know, we have this session on latest developments in international trade finance. The first speaker is Mr. Somasekhar Vuppuladhadiam, expert in international finance. He's a certified documentary credit specialist, CDCS, from the London Institute of Banking and Finance, UK, and also a certified associate of the Indian Institute of Bankers, CIIB, from IIB Mumbai, and also a postgraduate in international finance and banking, an MCOM from Karnataka University, Dharwad. He has over 40 years of industry experience, spread over 22 years with Canara Bank and about 18 years with Axis Bank. And his specialization includes NRI business, including heading an NRI branch at Canara Bank for 3 years, international trade finance, including digital banking products, treasury management, compliance and financial risk management. And he has addressed a number of programs with the Institute of Chartered Accountants of India, with the various chambers of commerce and various banks across the country. And sir, we welcome you, sir.
Thank you. Thank you.
The second speaker we have is Mr. Radhakrishnan KS. He is heading the International Business Division of South Indian Bank. He has over 26 years in banking at Axis Bank and Lord Krishna Bank, and also has over 18 years experience in the area of foreign exchange and trade finance. Sir, welcome you, sir. Right now, he is heading the International Business Division of South Indian Bank. Now, I would like to welcome you all for today's program on international trade finance. Now, the speaker, as I mentioned to you, Mr. Somasekhar, expert in international finance, and Mr. Radhakrishnan, head of the International Division of South Indian Bank. Our president was unable to come because of some personal reasons. We also have Mrs. Kamala Kumari, who is the AGM of South Indian Bank, Mr. Sachin Joseph, and other senior officials of the South Indian Bank. I have our co-chairman, Mr. Shenoy, and we have Mr. Telkar and our advisor. And we also have some of the other members from the South Indian Bank. I also would like to welcome the past presidents and their managing committee members, and also the invitees, ladies and gentlemen. As you all know, BCIC, it is our endeavor to create awareness on international opportunities and also to develop markets access for our exporters, and also empower our members in the global outreach for business expansion. As you all know, BCIC has opened a representative office in Tokyo, Japan on 6th October. Our main goal has been to help our members to collaborate with Japanese companies through BCIC office in Japan and invite Japanese companies to India. I request members interested in doing business with Japan to contact our office, Mr. Mulli Sir, who's advisor, and the Japan office of the BCIC will surely assist you in identifying companies in Japan. On the 28th of November, BCIC, along with Economic Development Board, Mauritius, and Indian Business Council, Mauritius, had a joint program. The objective of this program was to promote business between the two countries. BCIC has assured full support to companies coming from Mauritius and wanting to set up their business or have joint ventures with companies in Bangalore. BCIC is also promised to open a representative office now in Mauritius with the support of the Indian Business Council in Mauritius. Our committee has been doing a number of programs, and it was our desire to organize a program on latest developments in the international trade finance, keeping in view the dynamic changes which is happening in the global business. As you all know, the Ukraine war resulted in imports of petroleum products from Russia in Indian rupee. The government thereafter announced trade settlement in INR. On July 12th, 2022, the Reserve Bank of India announced a big decision by allowing trade settlements between India and other countries in Indian rupees. This measure was aimed at facilitating the growth of global trade with emphasis on export from India and to support the interests of the global trading community in Indian rupees. The decision to allow INR in international trade settlements is considered a very important step to facilitate trade with Russia, Iran, and Sri Lanka. INR in international trade settlements is also expected to gradually contribute to the global acceptance of rupees for international trade transactions. Though the FAQs published by Reserve Bank of India is self-explanatory, I am sure our learned speaker today will highlight some of the finer aspects. That is what the business people, they have the practical problems. So these sort of finer aspects and the benefits of cross-border transactions in INR for the benefit of our members who are exporters and importers. As you all know, rupee settlement mechanism introduced amid a steadily falling rupee would surely help India pay for its imports using rupees instead of US dollars from its foreign exchange reserves. This will, to some extent, lessen draining of forex and also reduce the dependency on US dollar requirements and also strengthen the rupee. This mechanism, I'm sure, will also reduce cost of conversion charges for exporters and importers. Friends, the other topic today is free trade agreement between India and Australia. Though we have the Australian Parliament, as you all know, passed the bilateral free trade agreement with India. This is very crucial for Australia to diversify its exports from the troubled Chinese market to India and also to forge new bilateral trade relations with India. In fact, it is estimated that the bilateral trade between the two countries, Australia and India, would go up from 27.5 billion to 45 to 50 billion in the next 5 years, which is quite a good number. This agreement, which was signed in April 2nd, would also provide duty-free access to Indian exporters of over 6,000 broad sectors, including textiles, leather, furniture, jewelry, and machinery in the Australian market. In fact, some of the labor-intensive industries sectors which would gain immensely also includes textiles and apparel, a few agricultural and fish products, leather, footwear, furniture, sports goods, jewelry, machinery, and electrical goods. I think the good news is that Indian graduates from STEM, that is the science, technology, engineering, and mathematics, will be granted extended post-study work visas. And also Australia will also set up a program to grant visas to young Indians who are looking to pursue working holidays in Australia. And in fact, the visa requirement, visa quota for yoga teachers and chefs have also been increased to 1,800. I think these are some of the advantages of this FTA. The economic agreements, which also stem from India's growing economic clout, also underscore a significant shift in our approach towards free trade and multilateralism. They will surely enhance India's integration with the world economy and deepen its participation in the global business value chain. Our experts, speakers, both of them have decades of experience, 40, 50, I think both put together about 100 years. I'm sure some of the other topics, they also would like to dwell upon some of the newer things which have happened in the last few maybe months. There have been a number of queries. I think you can use the chat box, and once they finish their presentation, I'll ask them to clarify your doubts. I would like to especially thank South Indian Bank for their support in organizing the speakers for today and also for sponsoring this program. With these few observations, thank you all. Thank you very much. Now, can I request Mr. Somasekhar, who can take over and address our members, sir.
Good afternoon. At the outset, I thank the BCIC for providing the bankers an opportunity to share some of our experiences, which would benefit the exporters and the importers present over the program. So I will not go into detail about the various intricacies involved, but as an exporter or as an importer, what is it that you need to keep in mind when you're doing business? So we'll start with that. What are the groundwork? What is the initial procedures that as an exporter you need to take into account? I know many of the participants are having considerable experience, but as a banker, what is the banker's perspective when we talk about exports and imports? So whenever we talk about starting an export or starting an import, initiating discussion with the overseas counterpart, that becomes very important. So as an exporter in India, I need to talk to the overseas buyer. Or as an importer in India, I need to negotiate with the overseas supplier as to what are the terms and conditions under which this transaction has to be carried out. So here there are certain ingredients, there are certain basic nuances that needs to be understood by the parties concerned. So when we talk about initiating the discussion, there are two basic concepts involved in international trade. One is the international commercial terms. The other is the international payment terms. So as an exporter, you should be aware of what are the responsibilities and obligations of the exporter and the overseas buyer. At the same time, as an importer, you need to be aware of what are the responsibilities of the importer and the overseas supplier. So whenever we talk about international commercial terms, in January 2020, there was revised Incoterms, which were established and brought into by the International Chambers of Commerce. So I will not go deep into what is this. International commercial terms is nothing but understanding the obligations and responsibilities of the exporters and the overseas buyer in case of exports, or importer and the overseas supplier in case of imports. So here, just to give a tip of an iceberg, X works. When we say X works, if the exporter has agreed to export the goods X works to the overseas buyer, the exporter's obligation is to manufacture the goods and keep the goods at the factory of the exporter or at the godown of the exporter. All other responsibilities like completing export formalities in India, covering insurance and freight payments, completing import formalities in the overseas importer's destination lies with the importer. So whenever an exporter is agreeing for X works with the overseas buyer, he has the minimum responsibility. That means the responsibility is only to manufacture the goods and keep the goods at his godown or the factory. All other responsibilities are taken care by the overseas buyer. Now, contrary to X works, we have DDP, delivery duty paid. So wherever an exporter is agreeing for delivery duty paid, all the responsibilities like manufacturing the goods as per the terms and conditions, completing the export formalities in India, covering insurance, covering freight payment, also completing the import formalities in the overseas country lies with the exporter. So the exporter takes the maximum responsibilities in case of delivery duty paid. So understanding the terms and conditions put in place between the exporter and the overseas buyer becomes very important. Or if you take an import transaction, understanding the terms and conditions between the importer in India and the overseas supplier becomes very important. So this is the basic ingredient in a trade transaction, because we have come across various experiences where some misunderstanding crops up between the buyer and the seller, between the exporter and the overseas buyer. So this can be avoided if the international commercial terms are properly understood. Now, next comes the international payment terms, how payment has to be received if I am an exporter, or how payment has to be made if I am an importer. So whenever we say payment terms, there are four models in international trade. One is advance remittance. So wherever an exporter is demanding advance remittance for the goods he is going to export, we put it under advance remittances. And here the exporter is not at risk because he is getting the remittance in advance. But here the reputation of the exporter lies in supplying the goods as per the terms and conditions and within the timelines prescribed by the overseas buyer. Now, As against advance remittances, we have open account system. Open account system is the reverse of advance remittance. That is, as an exporter, I am ready to supply the goods. I am ready to export the goods to the overseas buyer. And then after he takes delivery of the goods, he'll be making the payment. So here the exporter runs a sizable risk in the sense he is exporting the goods without getting payment, and he is also dispatching the documents directly to the overseas buyer. So the buyer's confidence in the exporter or the exporter's comfort in the overseas buyer's transactions is very important. Between open account system and advance remittances, we have what is called as documentary collections and LCs. So LC is the safest mechanism. Maybe many of us are aware that under LC, the buyer's bank, that is the issuing bank, gives us an undertaking, an irrevocable undertaking, that if the exporter supplies the goods and ensures compliance of the terms and conditions, he will get the payment. The LC will get honored. But LC results in some charges to the customer. Wherever an exporter has to get an LC from the overseas buyer's bank, the overseas buyer's bank will charge for issuing the LC. And at the same time, the bank in India also will charge for advising the LC. So mitigate or to avoid charges which are involved in establishing the LC, if the comfort between the buyer and the seller, the exporter and the overseas buyer, or importer and the overseas supplier is established, then documentary collections will be one of the ways where we can mitigate the charges. But here all depends on the trust. See, as an exporter, you should have trust in the overseas buyer. And as an overseas buyer, he should have trust in the exporter. Or when we talk about import transactions, as an importer, I should have trust in the overseas supplier, or the overseas supplier also should have equal amount of trust with the Indian importer. So this is the groundwork. These are called the ingredients in international trade finance. Without understanding or without knowing your customer, see, we talk about KYC. When we talk about a bank narrating KYC, bank will know who is their customer. Bank should know who is their customer, KYC. Likewise, in a trade transaction, especially in international trade, as an exporter, I should know who is my customer. At the same time, as an overseas buyer, he should know who is the exporter in India. So this is KYC, where the exporter has to ensure conducting a due diligence on the overseas buyer. How do I know this buyer overseas? I would have known through telephonic calls, or I would have known through some interactions during an international meeting or a seminar overseas. Or I would have known him through some of the references which my fellow exporters has given to. Or I would have got the references through chambers of commerce, through industry associations. So I should know who is the overseas buyer. KYC is very important in today's international transactions. Not only KYC, we also should know who is the customer's customer. That is, I am an exporter. I know my customer overseas. But I should know who is my customer's customer, with whom he is dealing with for his raw materials, or if there is any third party involved. Because many a times I am exporting the goods to ABC. ABC in turn will request XYZ to make the payment. So I am the exporter, overseas buyer is there, but payment comes from a third party. So in today's context, it's very, very essential that as an exporter, I should know who is the third party who is making the payment. So there should be a tripartite agreement, or there should be any documentary evidence linking the relationship between the buyer and the third party. Because FATF is Financial Action Task Force, which is an intergovernmental organization. So their objective is to combat money laundering and terrorism financing. So they have expressed concern to various countries across the globe that in an international trade transaction, knowing the third party is very, very essential. Because I know the buyer. As an exporter, I know the buyer. As an importer, I know the supplier. But sometimes I may have to receive payment from a third party, or I may be making payment to a third party. So that third party has to be known to the exporter or to the importer who is doing an import transaction. So this is very essential in building up a foundation for your export business. Then comes the role of the banks. So as an exporter, all of you will be aware that importers exporters code certificate has to be obtained. So any exporter who is into export of goods, or any importer who is into import of goods, he should necessarily obtain the importers exporters code certificate issued by the DGFT. Wherever the exporter is into software, there are lots of software exporters across the country. We are in fact monopoly in export of software. So the exporter who is into software, he has to get registered with the STPI, Software Technology Park of India. Then comes the other category, services. So today, there are 46 services established, recognized by the Ministry of Commerce. Ministry of Commerce has recognized 46 services which are exportable. That means any exporter who is into export of service, he has to first ascertain whether his service being exported is recognized under the Ministry of Commerce. Because as a service exporter, you are eligible for incentives from DGFT. So wherever an exporter is exporting a service which is recognized under the Ministry of Commerce, there are 46 services recognized, the exporter can claim incentives from DGFT. So what is the requirement for a service exporter? Point number one, he has to register with the Service Export Promotion Council, SCPC, depending on which is the nature of service that he is rendering. Or he can even register with the FIEO, Federation of Indian Exporters Organization. So as a service exporter, the primary requirement is like you take Importers Exporters Code Certificate for import or export of goods. For services, you have to register with the SCPC, Service Export Promotion Council, or the Federation of Indian Exporters Organization. Now, point number two, as a service exporter, if you are eligible for incentives, I'm repeating, wherever a service exporter is eligible for incentives from the Ministry of Commerce, it is mandatory that you have to get the Importers Exporters Code Certificate. Because many of the service exporters, they are under the impression that since they are exporting service, registration with DGFT is not required. But wherever the service exporter into export of service, and if he is eligible to claim incentives, he has to mandatorily register with the DGFT. So this is again one of the threadbare points which as an exporter of service, you need to keep in mind. Now comes the documents. What are the various documents that you need to put in place while doing an export or an import? This depends on the nature of the trade, the terms and conditions agreed to between the overseas counterpart and yourself, so that all clarity, whatever clarifications or questions you have to threadbare discuss across the negotiating table, because this is where the understanding and the trust between the exporter and the overseas buyer in case of exports, or importer and the overseas supplier in case of imports happens. So coming to the terms of payment, see, many times the exporter may insist for advance remittance. The buyer, if he is comfortable on the exporter, he may provide advance remittance. Or sometimes the buyer may insist for the goods to come first, which you call open account. So there again, if the exporter is comfortable, he can send the goods in advance, export goods in advance, and then get the payment. Documentary collections, routing the documents through the bank. And we have what is called as LC. So here, whenever we talk about LC, there's one important point which many of the exporters are maybe missing out. We have what is called as confirmed LCs. So for example, I am an exporter exporting to some country where there is severe externalization problems, or there are countries where the buyer's bank may not be immediately making the payment. So as an exporter, when I'm exporting to countries like say Kenya or Nigeria or Uganda, or even African countries, or many of the even Asian countries. So I can always ask the buyer, the overseas buyer, to provide for adding confirmation. That means the bank in India or the exporter's bank, say South Indian Bank, who is the exporter's bank. So the bank can add that confirmation to the exporter and advise the LC. So what is the advantage of adding confirmation? See here, it guarantees you payment. So when the bank is adding confirmation, bank gives you an undertaking that if there is a default by the buyer, or if there's a default by the buyer's bank, I will make good the payment. So bank is stepping into the shoes of the LC issuing bank. That means bank is taking an exposure on the overseas buyer's bank, overseas LC issuing bank. So once as an exporter, you have got a confirmed LC, confirmed by a bank in India or your own banker. Once you export the goods and submit the documents to the bank, complying with the terms and conditions, you are assured of payment. So here, this is one way of ensuring your payment. And tomorrow, if there's a default by the overseas buyer, the bank in India, which has added confirmation, they will be paying you the amount because they have already given an irrevocable undertaking. But here there are some charges involved. So wherever an exporter wants the LC to be confirmed, to be guaranteed by a bank in India, the bank will charge confirmation charges. And this is always negotiable depending on the relationship of the customer and the value of the transaction and the bank on which the bank is taking exposure. This is always negotiable. So this is again one area where exporters can take advantage of. That means if there is a default by the overseas buyer or the overseas buyer's bank, you are getting the payment from the confirmed bank. So when we talk about the methods of payment, these are some of the basic ingredients That you need to keep in mind. Then we have export finance. As a bank, it is now one of the priority areas where bank has to give advances to exporters. It can be pre-shipment finance or it can be post-shipment finance. And I think most of you are aware, wherever you have availed pre-shipment finance, this is for procuring raw materials or any other expenditure involved in converting raw material to finished goods. And wherever you go for post-shipment finance, after exporting the goods, bank again finances post-shipment finance by way of discounting the bills or negotiating the bills. But here one point which you keep in mind is the interest equalization scheme. So there is a very good benefit from the government of India by refunding the interest rates paid by the exporter to the bank who has financed the exporter. So I just give some elaboration. Any exporter who is exporting the goods, there are around 416 commodities identified by Ministry of Commerce, which are eligible for interest equalization scheme. And what is this scheme called? Wherever an exporter has availed export finance in Indian rupees. I repeat, wherever an exporter has availed export finance, whether pre-shipment or post-shipment in Indian rupees, the exporter is paying rate of interest to the bank. Now he can claim 3% refund from the government of India if he is MSME exporter, or if he is other than MSME exporter, he can claim 2% refund. So this is one scheme which is there for the past 10 years. The government has been extending this, and now it is extended up to 31st March 2024, not 23. It is extended up to 31st March 2024. So as an exporter, when you're exporting the goods, and if your goods are coming under the 416 commodities identified by the Ministry of Commerce, tell the bank also what they do is bank sanction you the export finance, and in the sanction letter itself, they will narrate. They will say that you are eligible for 3% refund from Government of India if you are a MSME exporter, or you are eligible for 2% refund if you are a other than MSME exporter. So here, another advantage which banks have been instructed is banks net off. That means if the bank says, I am charging you 9% rate of interest for a packing credit, now bank will reduce the 3% or the 2%, depending on who is the exporter, and they are collecting from you only the net amount, that is 7% or 6.5%, whatever it is. So here the exporter is again saved on paying the interest and getting refund. See, when the scheme started, it was like he will pay the interest to the bank will claim refund, and then that will be refunded to the exporter. But in today's context, banks net off. That is, every month when the bank is collecting interest from the exporters towards export finance, they claim the 3% or the 2% from Government of India, and they're collecting the 7% or whatever difference is there from the exporter, and then knock off the interest paid segment. So this is one area where many of the exporters are yet to take advantage. And keep in mind, this is only where you are availing export finance in rupees. Any exporter availing packing credit or post-shipment credit in rupees, he can straight away get a benefit of 3% in case you are a MSME exporter, or 2% if you are a other than MSME exporter. And this is reducing your cost of export, because this is one direct benefit which Government of India has provided. Now, apart from this, the other facilities, like for example, lots of trade fairs are happening overseas. So wherever there are trade fairs abroad, as an exporter, you can take your product abroad without any approval from Reserve Bank of India. So it is eased out to such an extent that as an exporter, if you want to showcase your products overseas by participating in the overseas trade fairs, or if you want to take your products for displaying overseas, that is an export transaction. Goods going out is export. But because this is for trade fairs, as a bank, as a AD bank, we can permit you to take the products overseas. But only thing is you have to give an undertaking that once the exhibition is over, or once the fair is over, you will bring back the goods back into India. And in case if there are sales happening in the overseas exhibitions, that is permissible. So if you take the product overseas, if that is sold in the exhibition, you are allowed to sell in the overseas exhibition, but you have to bring back the foreign exchange and demonstrate to the bank that the product which went outside has been sold. So this again is one of the areas where without approaching RBI, you are able to get the permissions from the AD bank. Then next comes the trade settlement, which is hot topic for the day. So today, when we talk about raising your invoices, so even earlier, any exporter can raise an invoice on the overseas counterpart in freely permissible foreign exchange, foreign currency. But today, by virtue of Government of India, through RBI entering into the rupee trade settlement, with many of the overseas banks, mainly Russia. And now there are lots of countries in the pipeline. So that means rupee settlement, trade settlement in Indian rupees. This is one product which can help the customers to mitigate their exchange fluctuation risk. So maybe conventionally what I was doing when I'm exporting to particular country, I'll be invoicing in a currency of that particular country. So I'm exposed to exchange fluctuation risk. But as a result of the developments based on the concerns expressed by the Russian government, based on the Ukraine crisis. So today we have brought in what is called as the rupee settlement through the Vostro channel. Now, most of you are aware, you have read in the newspapers as to what is the transaction like. But I'll explain you as a bank how it will be dealt with. Say, for example, you are an exporter, you are exporting to Russia. Now, in today's context, when you are exporting to Russia under the trade settlement route, you have the liberty to raise your invoices in Indian rupees. So as an exporter, you are raising invoice in Indian rupees on the overseas buyer. Now the overseas buyer, say you have an account with A bank in Bangalore. Now your overseas buyer has an account with X bank in Russia. So that X bank overseas, they will pay in rupees. In the sense, the X bank overseas, either they will be opening a rupee account with a bank in India, which is called the Ostro account, or X bank, if they don't have a rupee account in India, any other Russian bank who has a rupee account in India, transaction can be routed through them. So as an exporter, once you have completed your export, say you have shipped the goods, raised the invoices in Indian rupees, now you will come to the bank with all the shipping bill, all the export documents, including invoices in rupees. Now what the bank will do, bank will forward the documents to the Russian counterpart overseas because he has to accept the documents and he has to take delivery of the goods. So when the bank is forwarding the documents to the overseas Russian counterpart through the bank, it should happen through the bank. Now bank will give instructions to the Ostro maintaining bank in India. Say for example, my bank doesn't have an Ostro account. Suppose I am A bank in India, I don't have an Ostro account of a Russian bank. Now there are few banks, say for example, UCO, United Commercial Bank. They have a rupee account for Russian bank with them. That is called Ostro account, rupee account of Russian bank maintained with UCO Bank. So as a bank in India, when my exporter has given the documents, I will intimate UCO Bank that there is an export transaction where invoice is drawn in Indian rupees and this is the amount. So once I communicate to UCO Bank, they will note down in their records the shipping bill number. And as a bank in India, that is as a exporter's bank, I am dispatching the documents to the overseas exporter. Now when the overseas buyer makes the payment, he makes payment in rubles to his bank. He will instruct his bank to debit his rubles account. So that bank will debit the rubles and they will see what is the conversion between ruble and Indian rupee. And they will instruct the bank in India. They will instruct United Commercial Bank, you debit my Ostro account for this much rupees and pay to the exporter. So there is no question of inward remittance coming in foreign currency. So the transaction happens through Indian rupees in India. So once I have instructed United Commercial Bank as a bank, once my bank has instructed United Commercial Bank based on the instructions from the overseas Russian bank debits the Ostro account in rupees and they'll pay me in rupees. And I will in turn credit my exporter's account. So this happens through RTGS NEFT. So there is no question of swift transmission. See, earlier there were lots of concerns with the exporters telling that my remittance has been remitted by the buyer. Buyer's account is debited, but I am not able to get the proceeds. So these were some of the complaints by the exporters. So through the rupee settlement mechanism, everything happens within the Ostro mechanism. So to give an example, now, for example, my bank doesn't have Ostro account. My exporter, an exporter dealing with my bank may not have Russian bank's account with me. There is no requirement. But Russian bank's account is there with other banks like UCO Bank, IDBI Bank. So when Russian bank gives instructions to them, this UCO Bank or IDBI Bank, they will debit the Ostro account of Russian bank, which is in Indian rupees, and they will transfer to my bank through RTGS or NEFT, the export process. That means I raised my invoice in Indian rupees. I got realization in Indian rupees. So that is where I am saving on the exchange fluctuation risk. Otherwise, had it been in dollars or in euros, I would have raised dollars 3 months back. I would have raised the bill 3 months back when the rupee was, say, for example, 83 rupees or 84 rupees or even 80 rupees. Subsequently, when I realized the bill, if the rate is coming down, if rupee has appreciated as an exporter, I might have lost on the exchange fluctuations. So to safeguard the exporters from losing out on exchange fluctuation risk, this rupee settlement is very, very important. And here now we have seen in various media reports that there are at least 26 countries who are now asking India for going through the rupee mechanism. So there are 26 countries who have represented to the RBI and the Ministry of Finance that their banks also want to open rupee accounts in India, and they want settlement through rupee mechanism, because this is one, I should say, this is one of the revolutions. See, earlier we had this rupee mechanism. Canara Bank and State Bank of India, they had arrangements with Russian banks in rupees, settling in rupees. But that was under state credits. It was called as an arrangement where state credits was the nomenclature. But there many of the people did not utilize that particular channel, because those days it was happening smoothly. But today a time has come where exporters who are mainly exporting to the countries where they are seeing a requirement for rupee transactions, it's better we invoice our currencies in rupees. So this is one of the revolutions in trade finance. And as an exporter, he has to take advantage, because there is no need for you to now monitor the market. Earlier, when you have raised your invoices in foreign currency, you need to monitor the market. So what is rupee against euros, rupee against dollars, rupee against sterling pounds? But today, once you raise in Indian rupees, there is no issue at all. And moreover, many of the countries are now encouraging rupee settlement. They are now coming forward to India, and especially after the G20 meeting. In fact, there was a news report that even during the G20 meeting, many of the countries have told that we want to establish rupee settlement mechanism with your country. So that is the extent of significance that this particular initiative from the government is helping the exporters. So now, the other point, Madam, can you just put the, I think there are lots of questions. The questions I have gone through. Maybe the questions are very valid. I'm very happy that there are lots of questions connected to your regular requirements of your business. So shall we take the questions later?
I just want, yeah. I thought.
Okay. Now what I'll do is we will not go through the presentation.
Yeah, let him.
Okay,
speak.
let him speak.
Yeah.
I have only one slide, free trade agreement with Australia. That is the only 2 slides. The last 2 slides I will do after he has finished this.
Fine.
You can now.
Okay, now.
Presentation. You have a
presentation, but I will speak.
Okay. If you want, no, if you want, we can flash it.
Okay.
ಇದು ನಂದು ಬೇಡ ಈಗ ಅವ್ರದ್ದು ಮುಗಿಲಿ. So we'll take up the questions later.
Yeah. So now I'll request Mr. Radhakrishnan to give his views, and then later on he has another presentation on the FTA, and then we'll take questions.
Yeah, very good evening to all the members present in offline and online in this seminar. So first of all, I will thank Mr. Ravi and Mr. Shenoy, sir, which we are frequently interacting with them, for giving the South Indian Bank an opportunity to present in front of the community, which we call it as a premium community, because BCIC, as far as my discussion with them, is a premium organization. One of the Chamber of Commerce having foreign offices also for this organization, so which makes us happy to associate with the BCIC. So we will, on behalf of South Indian, I will thank first of all to BCIC for giving the opportunity for presentation.
Thank you.
So coming to our presentation, you can come to the next slides. This I will speak later. Come down, come down. Yeah. As we are aware, when we interact with the customers or other market participants, many of the transactions which customers are doing, exports and imports, the guidelines on FEMA are, many of the customers are aware, like in the sense of what is the timelines of submission of bill, shipping bill, bill of entry, remittances, what is the timeline, etc. But when it comes to the capital account transaction, in FEMA there are 2 types of transaction. One is current account transaction and second is capital account transaction, which is displayed in the screen. So current account transaction, many of the company team, finance team or other export import team or the CFOs may be aware what is the timeline, etc. and they can handle it pretty good. But when it comes to when we speak customers regarding the investment opportunities, when an Indian company investing in abroad or acquiring a company in abroad, or a foreign company acquiring in the equity shares of Indian company, and a Indian corporate taking a loan from abroad, that is called external commercial borrowing. And opening an office abroad. These kind of transactions require lot of Reserve Bank of India reporting from the customer side as well as from the bank side. On current account transaction, bank is only reporting in our return or shipping bill, etc. But customer has to submit the documents. That's all. That reporting ends there. But in this case, corporate or the company has the responsibility to report the transaction on the pre-transaction stage as well as the post-transaction stage. Post-transaction, I would say, is more of the corporate's responsibility and timeline also. Now if there is a reporting coming after the expiry of time limit, corporate needs to pay LSF, late submission fee also. Reserve Bank of India has given that fees also because they want there should not be any contravention of FEMA on reporting side when the investment comes. So first we will talk about the FDI, foreign direct investment. That means a foreign company investing into the equity of the Indian company. So when foreign direct investment, now the reporting has become online. Earlier it was offline reporting. Now Reserve Bank of India has made reporting online. Not now, it was 3-4 years before onwards. One new portal has been started. So when we come to the transaction side, when a foreign company invests in Indian company, first thing is a sectoral cap. Government of India or DAPP has issued some guidelines, which are the sectors fully permissible, which are the sectors regulated, which are the segments prohibited. So, for example, some real estate transaction, etc., all prohibited on the transaction, on investment, foreign investment, or key sectors like defense, which are not open to investment, foreign investment, that are prohibited. But some are partially permitted. Banking or insurance, etc., 74% foreign, like that, some guidelines are there. Some sectors are fully permissible. 100% a foreign company can hold the shares of Indian company. So, like that, 3 divisions are there. So when it comes to the banking side, whenever a company want to get an investment from, because when the customer dealing with foreign companies for export or import, after a lot of deliberation, that company will be interested to invest in your company, or you will ask the company for investment for a capital raising, etc. Then first activity is the valuation of the company. Indian company will be valued by the foreign company, and the pricing or shares will be arrived. For that, a share purchase agreement will be signed between the Indian company and foreign company. So when it comes to the banking transaction, first share purchase agreement, then we will take the documents related to the valuation, then board resolution, because the board has to approve the investment from abroad, and the checklist will be there from the bank, MOA, AOA, and the buyer-seller consent, etc. After that, the fund can be repatriated to India. But one important point is the KYC of remitter. KYC of remitter is mandatory before application of funds. So that is the responsibility of the bank. RBI has given a set of KYC questionnaire, which we will take from the foreign bank directly through SWIFT. So on getting the KYC document or SWIFT from the foreign bank, we can apply the funds to the customer. After getting the share purchase agreement and valuation, etc., we will apply the funds. So in valuation also, chartered accountant or company has to play a good role in the sense of the valuation of the company has to be internationally acceptable pricing standards. That some terminology they have a discounted cash flow method or net asset value method, like that. It is so on that basis, bank will scrutinize the document. And RBI has given the authority for banks to scrutinize, and even banks can approve the transaction. Earlier, it was going to RBI for approval or UAN. Now, banks can approve. But if there is a timeline expiry, or after the timeline, customer submit the document, means it has to go to RBI for approval. So, on getting the investment into the company, within 60 days of remittance, after getting the within 60 days, the corporate need to issue the share to the foreign company. And within 30 days from the date of issue of shares, the company needs to file FCGPR. Form FCGPR file need to be submitted, which is an online. For that also, banks can help the customer in the sense that first customer has to, there is a portal FIRMS, Foreign Investment Management System. In that, customer will first register the entity. The corporate will register the entity with their credentials, CAA number, and their offices, credentials, etc. Then, second, they will create a business user, in which bank will be selected. From which bank this remittance has been handled, their AD code or IFSC code will be registered. Then that entry will come to the bank, because since you are selected IFSC of South Indian Bank, it will come to our bank. Then we will approve the user IDs. After getting the user ID, many of the companies, their company officials maybe or chartered accountants will be doing that activity because they have proficiency in that. So after getting the user ID, the customer will upload the documents. Whatever I said in the checklist, he will upload the documents because before that bank will scrutinize the documents. After that only customer will upload that. So once it is uploaded within that timeline stipulated, bank will again scrutinize the transaction. Then it will be approved. Then automatically customer will get the FCGPR approval form, which will be having a unit identification number, and it will be having the share number of shares and pricing, etc. will be mentioned. This document is important in the sense that whenever the Indian company, foreign company disinvests from Indian company, this is required whenever the fund is going abroad. Now, when the fund comes abroad, this is recorded in RBI that FCGPR number, this one, this company, etc. But when it is after 1 or 2 years with the dividend, or maybe after 1 year, the company declared dividend, the foreign company wants a dividend back. At that time also, this FCGPR approval from Reserve Bank of India is important document for repatriation of funds. Maybe some companies, when we discuss, some companies may not be aware of this guideline, so they may not have reported also this company. Then maybe some companies, because when it is reported that it's an investment in India, then bank will follow the guideline. Earlier, maybe 5 years, 10 years before, these kind of transaction very less. Now also it is now coming up, but the company has declared as a general application of fund. For that, this reporting was not done. The share, maybe they have issued the share, but purpose was declared in banking sector as a different purpose. Then we need to regularize that after getting the documents and regulation of purpose, etc. We'll regularize it, and that is why when this timeline is crossed, there will be a contravention in FEMA. So that we can avoid if we follow these guidelines. Second, on the ODA, reverse of FDA. Indian company, because when we see our foreign market, we have a lot of opportunity in R&D or our products to sell in the market. So if we have our own wholly owned subsidiary, or we can have a JV model. There are two models, joint venture model as well as the wholly owned subsidiary model. Wholly owned, 100% of shares of that company will be owned by the Indian company. JV means maybe some portion, 50% or 20% owned by. In some countries, there is a regulation that local company or individual has to hold some kind of. So they will hold, depending on that country regulation, that person will hold some share in share, and rest we will be hold. So JV kind of model it will be there. That can be utilized for Indian company to market their products, warehouse kind of thing, everything they can utilize that. So for that also RBI reporting is mandatory. In that, first, the same thing, whenever an Indian company, there are also sectors mentioned, whichever sectors, maybe this real estate, etc. are not permitted. And as Somasekhar sir was saying, FATF compliant countries, that is also there, because FATF, Financial Action Task Force, publishing some countries in a different kind of listings, blacklist, grey list, etc. etc. So depending on the country standard, because what is the credibility of that company abroad, they need to identify in case of JV. So with that, if the FATF guidelines are followed by that country, it can be accepted. So in that case also, when the investment happens, it will be reported to RBI as a unique identification number, which bank will report. In that case, company doesn't have online portal, bank has a portal. We will report the transaction first, on which we will take the board resolution of the company, investment report, that foreign company's credentials, the report, this credit opinion reports, or confidential reports of the company, plus the valuation of shares, etc. we will take. And after the remittance, we will report the transaction in OID portal, Overseas Investment Division portal, and RBI will allot a unique identification number for the company and AD. So in this case, if the investment happens through one bank, A bank or South Indian Bank, that to that bank, they are issuing the UAN number. For subsequent remittances, all will happen in that UAN number in that bank. Change of UAN is also permitted. Maybe tomorrow next transaction is going on some other bank. This AD UAN can be transferred to the next bank. And it's an online mechanism. We will, as per the request of the Indian company, we will transfer that AD to the another bank, depending on the situation. So after that, within 6 months from the date of remittance, Indian company should get the foreign company's shares. Shares to be get from the company within 180 days, and it has to be submitted to the bank for verification. That is one timeline. If it crosses, there can be late submission fees will be applicable. Then second thing, every year, whatever be the foreign company's financial year, which is a calendar year or a April, March kind of calendar year, before December 31st of every year, Indian company needs to submit APR, annual performance report, in which all the details will be mentioned. what is the foreign company's turnover, the profit, etc. With that balance sheet, they will be generating. That is also mandatory thing in the sense if it is crossed that 31st December, it is a contravention. So there can be less submission fees also. So in case of earlier many because I think in this group we have new companies are there plus existing companies are also there. So in that case, this timeline has to be followed. Otherwise, this will. So in case of transaction previously happened, this may not be done by the company. Now RBI in August 2022, RBI has issued a regulation on overseas regulations. It was widely discussed in the platform also because RBI has given the opportunity for company to regularize the transactions. Whatever happened earlier without reporting APR or share certificate, etc., they can regularize it after that following that procedure of that. And they have introduced new sectors also, strategic sector, one new for startups, oil companies or submarine companies. They have classified that they will add the new sectors in that strategic sector so that it can be easily invested abroad. So for ODA transaction, these two are the guidelines. And when the company or foreign company, the JV or WS is disinvested, that can also be reported by the, and then the fund will also come back. When we are invested abroad, the fund can come back. Maybe the foreign company can also fail. In that case, it can be a loss. There is a mechanism for RBI to report the loss of the foreign company and winding up of that company with the profit of business. Then we can repatriate. When the fund is repatriated, as I said, the earlier reporting must be there. That UAN should be taken at the time of investment. Like FDI, similar to SBI, FDI, ODA also, these documents are important when the fund is coming back to India. Third will be external commercial borrowings. That means Indian corporates for their long-term borrowing, they will be availing some loans from abroad. So the loan, there are two categories, eligible borrower and recognized lender. The borrower is eligible for raising ECB will be the sectors which are permissible for FDI. Those sectors which are open for FDI only for those sectors ECB is permitted because ECB proceeds can be converted to equity on a later stage. So when it converted to equity, the foreign company will be holding that. So for that purpose, the FDI, whatever sector is permissible, it will be permissible for ECB also. The lender can be any foreign branches of Indian banks or any financial institutions approved, financial institutions abroad, or in case of this foreign investor in a company, if there is a foreign investor, he can also lend in certain cases. So these three type of lending the customer can take. In that also process are very simple. First, customer will submit the loan agreement between the foreign company and borrower and lender. And in that, there are some things we need to take care is that the interest mentioned, all in cost one guideline is there. In that, it should not cross SOFR plus 550 points if the minimum average maturity period is over 3 years. So that has to be there in the loan agreement. If it should not be that it crosses a certain guideline, it should be RBI. A sectoral guidelines also to be followed. And once the agreement is in place, RBI will give a loan reference number for the transaction, which will be quoted in all their other transactions. So first the customer will submit the form ECB. That form is called first time application to Reserve Bank of India, or the bank is called form ECB, in which all the documents plus agreement will be there. But bank will follow only that form to RBI. Other things, AD bank will scrutinize it and approve it. So once we get the LRN number, the proceeds can be drawn down to India. That foreign currency loan can be drawn down to India and for utilization purpose also. After the drawdown of funds, every month, the Indian customer has to submit a form ECB2 return, monthly return within 7 days from the availment of loan, in which the interest maybe in the case maybe 1 year interest payment may not be after 1 year it will start, or 2 year, or immediately on the next month itself it will be starting. So for that purpose also they will mention the interest payment, principal payment, and what is a residual period, etc. They will mention every month. It has to be, even if there is no repayment also, first month onward ECB2, even if there is no transaction, we need to submit it. Otherwise it will also crossing the times. Second, customer has to, these two are the documentation which customer or Indian company has to do in terms of ECB, external commercial borrowings. And after the end of the loan, it can be automatically closed because bank will report the bank that this loan has been closed, then they will close the LRN. Third, fourth one is the maintenance of office abroad. Indian company not investing as a JV or WS, but an office they are making for a marketing purpose. In that case also, they can form the company in abroad and the activity will be for the marketing purpose or license purpose only. And initial setup for setting up the company, initially the company can send remittance up to 15% of the average annual sales turnover of previous 2 years. 15% of average annual sales turnover of the previous 2 years of the Indian company can remit abroad for initial setting up of the. So initial setting, they have to identify a consultant for documentation, etc. Form the company. For that, they have to send some funds to the consultant also. For that, this is the guideline. Or 25% net worth of the Indian company. Either the average annual turnover or 15% of average annual turnover of the previous 2 financial year, or 25% net worth of the Indian company. They can remit as a first setting up company. Second, for subsequent expenses, because the Indian company will depute an officer there, they will find an office, computer, desk, or the regular expense, electricity payment, or office expense will be there. For recurring expenses, 10% of the average annual sales turnover of 2 years, of previous 2 years will be considered for recurring payments. With that, they can run the office and do that branch office or license officer. Later on, it can be converted into a subsidiary or JV depending on the situation. This is only for the license purpose. The fifth one is, now many foreign companies are opening offices in India, like license office, branch office, project office, etc. The reverse of Indian company opening there, foreign companies are opening offices in India. For that, RBI approval is required upfront. Then in that case also, foreign company can approach a bank in India or through a consultant or chartered accountant or company secretary. They will come in, they can form the company, and they can submit a form called a form FNC for submission. In that, full details of the foreign company, Indian office, what is the activity, what is the proposed office pattern, etc. Everything will be mentioned. And on submission of that, ID bank has to scrutinize the document, what is the activity, permissible activity, negative activity, etc. Then we will represent with our recommendation to Reserve Bank of India. They will scrutinize the document and they will allot a, like this UIN number, unique identification of foreign, when they will be allotting. After getting that UIN number, the bank can open the account for the company. Within 6 months from the date of UIN allotment, they have to open. Maybe in some companies, they may not open after that, because of some reason, they may not have. In that case also, we will inform the company. If it is not going through with that UIN number, we can report RBI that this is not open, it can be closed like that. And this Indian company, this license office or branch office, they have to report an annual activity certificate. Like in ECB, AP annual performance report, this is called annual AAC, annual activity certificate, to the AD Bank in India, which will be submitted to bank as well as Director General of International Taxation. It's a income tax department which is having international tax. So both the tax department and bank, they need to submit the annual activity certificate in which all their year-wise financials, profit, sales turnover, etc. will be mentioned. So with that, bank can approve that AAC, and we can report to RBI also. If there is any time limit crossed, then again it will be a contravention. Then late submission fees, etc. will be applicable. So these are all the guidelines on FDI, foreign direct investment, foreign company investing in India, and ODA, reverse of FDI, Indian company investing into the foreign company shares, and external commercial borrowing, Indian company opening a foreign office abroad, and license office, branch office, or project office in India. Along with that, can we go to the earlier side? Just to add about the features of South Indian Bank. South Indian Bank is headquartered in Thrissur, Kerala. We are having 930 branches across India. We have customer base of around 7 million, including NRI customers base are there. And we have all the type of international banking, corporate banking, retail banking, personal banking, all type of things. And we have all the departments available. And recently, if you have read in newspaper, we have got digital awards from IBA, Indian Banks Association, which is a corporate body for all the banks in India. 6 of the awards was received to South Indian Bank. So these are all the details about South Indian Bank also. I thought I will share that in this community. Thank you.
So thank you, Mr. Radhakrishnan, for giving an overview about the UPI and a lot of other things. I'm sure it was very useful for fresh exporters. I think we have something left for Mr.
How much
Somasekhar.
time I can
You
take?
can take another 10
Okay,
minutes.
I'll just,
Yeah.
yes.
And after that, we can take the Q&A. I think you can
So,
put on the.
ಇಲ್ಲ ಬೇಡ, ಇದೆ sir. So, again, thanks for the patient hearing. Just I wanted to highlight on some two important aspects, which are very much important for the exporters and the importers, exporters especially. So here we have free trade agreements. So here India has been extending lots of free trade agreements with various countries. So we have earlier, prior to this, we had with Cambodia, we have with Malaysia, we have with Singapore, we have with Bangladesh, we have with Sri Lanka, we have with even small countries like Laos. The recent development is that the free trade agreement between India and Australia is coming into place from April 23 onwards. So whenever you talk about free trade agreements, there are 2 points which as an exporter or as an importer, you need to keep in mind. One is as an exporter, when you're exporting, the overseas buyer is bound to make payment of import duties in his country because for him, it's an import transaction. So here, wherever India extends or enters into a free trade agreement with the overseas countries, this particular duty that is being paid by the overseas buyer is exempt. So that means the buyer will look at India to import the goods or services or software rather than looking at other countries where there may be restrictions. So here as an exporter, when you are exporting goods to Australia, so today this particular free trade agreement covers a wide range of products. I think there are at least very important 25 to 26 products, which at least I have gone through. Agricultural products, fishery products, you have machinery, electronic components, you have pharmaceuticals, you have medical equipments, food and food products. There are many products which are brought into in this particular agreement. As an exporter, you can take advantage of. That means when you're exporting to this particular overseas buyer under the free trade agreement, his cost with regard to paying import duty in his country is reduced. As a result of which, he will be looking at exporters in India to procure the products from. So here there are two things here. As far as free trade agreement is concerned, there are no exemptions like you are otherwise being restricted to. So whenever you talk about foreign trade policy, we have three components in foreign trade policy. We have the prohibited items, we have the restricted items, and we have the freely exportable, freely importable items. So some of the exporters, they used to call me and ask whether we can export goods which are restricted. That is not possible because that is the policy of the country. So when the country says, I'm prohibiting 56 or 57 items, even if it is free trade agreement, you cannot export that because that is prohibited. Second is there are some customers who are intending or who should get licenses from DGFT to export the goods. So some customers may think that under free trade agreement, we need not take licenses. That is not wrong. That is not right. You have to obtain licenses. So foreign trade policy, when we say free trade agreement, in consonance with or in sync with foreign trade policy, you have to adhere to all the foreign trade policy aspects while exporting. There is one more important point, the consular invoices. Under free trade agreements, it is mandatory that the exporter should get his invoice attested by the consulate in India. Say, for example, when you are exporting to Australia, because the importer is claiming zero duty cost from his country, he has to demonstrate, the overseas importer in Australia has to demonstrate to his trade authorities that the export has come from India. And to demonstrate that, the invoice raised by the exporter should be attested by the consulate in India. So that one point you have to take care of. And again, certificate of origin, which is issued by the Chambers of Commerce. That is again a mandatory document because unless the documents prove that the origination of goods is from India, they will not be able to get duty reduction in their country. These are the two things. Now there is one more point called most favored nations. So whenever you are exporting, there are certain nations which are most favored nations where the customs duty is cheaper as compared to other nations. So Australia comes under most favored nations. So in today's context, after having entered into free trade agreement with Australia, if a particular goods is levied with say 2% customs duty in Australia, and if the most favored nation's custom duty is around 1%, he will get the benefit of 1%. Whichever is lower is charged. So these are the 3 points as an exporter you have to keep in mind when you are transacting with countries with whom we have free trade agreements. And government is very much hopeful that as Indian exporters, you will be bringing in lots of foreign exchange into the country. Because when you see the rupee dollar parity, Today's rupee is depreciating. But that is not a panic because all exporters should be happy because when what was 79 rupees last year, today it is 82 rupees. But at the same time, appreciation of the home currency is always better because the enhancement of economic stability and the financial stability of the country increases. Added to that, as an exporter, you bring in lots of forex reserves. And today our forex reserves are at $564 billion. What was $650 billion last year came down to as low as $520 billion. And today we have revived again. We are now at $564 billion. And government is hopeful that by March 2023, our exports will touch $400 billion. And also our FDI flows, foreign direct investment flows, will touch $100 million. So with all this, there are lots of hopes, lot of aspirations that the exporters and the importers should pitch in for their goods to be exported or importing the technology or whatever services they want. The other point which I thought was the EDPMS and the IDPMS. These are the two hot topics for an exporter and an importer. So as an exporter, it is your obligation, it is your responsibility to ensure that you get the foreign exchange into the country for the goods you have already exported within a maximum of 9 months from the date of shipment of goods. As an exporter, if you have shipped the goods on 1st January 2022, as per the regulatory guidelines, you have to get the foreign exchange into the country before 30th September 2022. That is the maximum period allowed by regulator to get foreign exchange. In case if you are unable to get the realization within the 9 months period, you can always take up with the buyer. And in case if the reasons put forth by the buyer are beyond his control and you are acceptable to the reasons, you can even extend the period of realization. And this extension can happen only at the discretion of the bank. So you have to approach the bank for extending the period of realization. So as long as you are getting the foreign exchange into the country for the export you have done, your entry in EDPMS remains outstanding. So as an exporter, in the spirit of the guidelines, you have to ensure that you reduce the entries in the EDPMS. What does that mean? You have to get your export bills realized well within the stipulated period of maximum 9 months. Likewise, as an importer, wherever you have made remittances to the overseas supplier, you have to get the goods into the country. So till such time you get the goods into the country, your entry with the bank is outstanding. That is one way. The IDPMS, we call ORM entries, that is pending. Now, wherever you have got the goods, sometimes the overseas suppliers have supplied you the goods. He says that you make payment after 3 months or after 6 months. So here, as long as you are not making payment to the overseas supplier, your entry in IDPMS remains outstanding. And that also is a concern for RBI. So as an exporter, ensure that you clear off your entries in the EDPMS. And as an importer, ensure that you knock off your entries in the IDPMS. Because there is a concept called caution listing of exporters. So today, RBI has given the discretion to the banks to caution list the exporters. That is, wherever an exporter is not realizing the foreign currency, not realizing the export bills, within a maximum of 2 years, the exporter will be subject to caution listing. And one disadvantage of getting caution listed is your accounts will get frozen with the banks and no other bank can handle your export transactions. And that is the seriousness with which exporters need to ensure they get the foreign exchange into the country. They get their exports realized. But wherever you are unable to get the bill realized, overseas buyer is defaulted. He is an intentional defaulter. He is not traceable. He is absconding or he is insolvent. So wherever you come across instances where the buyer is any of these reasons, you can approach the bank for write-off of an export bill. Writing off means you are booking losses in your books of account and the bank will close the entry in their system and the RBI also will knock the entries in their EDPMs. So these are some of the points which I thought I will share with you. Of course, with the time allotted to me, I thought I will share with you the maximum points because foreign exchange is a very elaborate subject. Exports alone, I talk for almost 6 hours or sometimes even 2 days because there are lots of information that needs to be given to the exporters and many of the exporters may not be aware of some of the finer points in trade transactions. So I thank the BCIC and also I thank the bankers who have given me some space to share my experiences. But definitely, if there's an opportunity, we will again come back to you with more details and more intricate solutions to whatever problems you have. Thank you.
So thank you very much, sir, for a fantastic presentation. You didn't see a slip Everything was extempore and the flow was excellent. Sir, before we already have some questions which have been raised by some of our members. And before that, I would like to ask you one or two small questions. Point one is many members are asking, I have an option today to raise an invoice in dollars or INR. So what is it? I mean, I know when the dollar is appreciating, it makes sense to do it in dollars. Okay. But as of today, what is it you advise as an expert is number one. And number two, you mentioned that whenever I export under the FTA, you have to get a endorsement from the consulate. Now, for every transaction, every invoice, has it to be done, or is there any exemption? Because as I know, you're getting a document from the consulate, they work only 5 days a week, and they charge you some $50, $25, or $100. It's quite expensive, and some cities do not have the consulate. So, how do you this challenge? No? How do you mitigate it?
So I'll come to the second question first. See, in case of FTA agreements, as far as the earlier FTA agreements was concerned, that was a requirement. But now I understand from the CII, Confederation of Indian Industry, when I spoke to them last week, they said that they are discussing with the government to come up with some via media to not to inconvenience the exporters. So they were telling that there is something we are discussing. He didn't disclose what is it that was being discussed. He said that we are discussing something so that we will not inconvenience the exporters on this particular part, on the consulates attesting the invoices. So that is one thing which we had to wait and see on the modalities. Okay. Having said that, even on the FTA agreement with Australia, we have not yet got the full-fledged modalities and the guidelines. Maybe we'll be getting before April 23, we should get it. So that will be in the to the benefit of the exporters only. That is one. And now coming to raising of invoices. See here, raising invoice in rupees is not today's regulation. It's there right from the day the FEMA was established. Right from 1999, FEMA has provided a provision that exporters can raise invoices either in a freely convertible currency or in Indian rupees. But the realization should happen only in freely convertible currency. So even earlier, when I'm raising invoices in Indian rupees, I was either getting through the Vostro channel. I'll give a small example. So for example, as an exporter in India, we had one customer who didn't wanted to take the exchange fluctuation risk. So he had discussed with the overseas buyer. The buyer had agreed for raising in rupees. So he raised invoices in rupees, and the buyer's bank, Silicon Valley Bank in Chicago, they had a rupee account with bank in India. So they used to tell the bank in India to debit their rupee account and pay to the exporter in India. But that was not very popular in those days because everyone wanted foreign exchange into the country because dollar was appreciating. In the sense, rupee was depreciating. So everyone said that when dollar appreciates, I'll be getting more rupees on hand. So that was the reason why many of the exporters didn't took that. So that was there even earlier. But now coming to the current situation, wherever the Vostro accounts are there for the bank. Suppose I'm an exporter, I'm dealing with State Bank of India. So as an exporter, check with State Bank of India, how many Vostro accounts they have and which are the banks who have meeting rupee accounts with State Bank of India. Suppose, say, for example, Commercial Bank of Ceylon, if they have a rupee account with State Bank of India, an exporter who is exporting to Ceylon can always raise invoices in rupees also because the Vostro channel is already there. Now coming to the based on the Russian-Ukraine crisis, now many of the overseas banks are opening Vostro accounts with banks in India. Even there, if my exporter and the overseas buyer is agreeable for routing the documents through rupees, raising invoices in rupees, it is possible. There is no restrictions on this. As long as the remittance comes through the Vostro channel, in case of rupees, it can be done.
So as we, I think some of the questions which have been raised, probably you can answer. Meanwhile, if there are any queries, I request the people online can use the chat box. Ma'am, anything in the chat box?
There are two questions, sir. They have mentioned it to Mr. Radhakrishnan. They have asked, foreign company loan availed, is there any time frame to repay the loan?
Foreign currency, can I answer?
Yes.
See, this is e-Biz. Suppose if the participant is asking foreign currency loans availed, are they having any timelines to repay? This is only ECB route. Any Indian company or any entity in India can avail loan from overseas under the ECB route. And the repayment is as per the terms and conditions which are defined in the agreement. So timeline means the minimum average maturity is 3 years. And if the sanction term says 5 years is the maturity period, he has to repay within 5 years. So all depends on what is the sanction terms and conditions put in place by the overseas lender. Is that right?
Yes,
Yeah.
sir. What is the mentioned in the buyer, the lender and borrower agreement? It will be, as sir said, correctly said, there are minimum MAMP, minimum average maturity period defined by RBI, which is minimum 3 years. Above 3 years, it can go. Depending on the sector wise, it may divide. The circular RBI clearly mentioned some companies like NBFCs for working capital, general corporate purpose, etc. Some are 5 year, 10 year minimum should be there. So that depending on that, the agreement, they can repay the loan.
Let him go through the sanction terms and conditions, which gives you what is the maximum.
He has one more question, Mr. Sandeep Parvartikar. He has asked, bilateral trade agreement happened with Australia. How my customer in Australia is benefited?
That is zero duty.
Zero duty.
Wherever he is importing from India, he has zero customs duty to be paid there. That is the advantage. Earlier, it was around 3 to 4%. Now he is saving on that. So he will be instigated to deal with the exporter in India.
That's all, man.
Yes.
I think I want a couple of questions here. We are seeing everything online.
Yeah.
I want the benefit of people who have come all the way. If you have any questions, please do raise it.
Not from my end, sir. It was a silly question. I mean, basically, what is the difference between DDP erstwhile, compared to the erstwhile CIF? I mean, are they same or?
No, see, CIF is still there. CIF is cost, insurance and freight.
Correct.
So as an exporter, when I'm agreeing with the overseas buyer for CIF basis, I'm covering insurance and I am covering freight payment. Now, DDP is if as an exporter, I agree with the overseas buyer that I will agree for delivery duty pay. That means as an exporter, I have to not only manufacture the goods, not only complete export formalities, not only cover insurance and freight. At the same time, I have to ensure arranging import formalities in the overseas country and deliver the goods to the factory of the buyer or to the destination of the buyer. That is delivery duty paid, where the exporter has the maximum responsibility.
So basically, as an importer, I think DDP is better than CIF.
No, all depends on, it's a very valid question. See now, for example, I'm an importer in India. Okay, now as an importer, if I'm an MNC company in India, I will tell my overseas MNC company that you deliver the goods at my godown in India. Or wherever I have good associates in the overseas place, I can go for X works also. Because see, when you go for X works, as an exporter, when you are telling X works, your price is not competitive. In the sense, suppose you are exporting cotton shirts, you say $10 per cotton shirt. Now, if you say, I will be agreeing for X works, you may get only $8 because the buyer is taking all the other responsibilities. So here as an exporter, when I agree for X works, you are losing out. You know why I'm telling this? Because in India, as an exporter, I can bargain with my insurance companies for insurance premium. I can bargain with my freight forwarders for freight payment. So I have the capability to tell in my own language and bargain for the insurance and the freight. So when I load this insurance and freight in my pricing, suppose instead of $10 per shirt, I can quote even $15 or $14 per shirt. So when he's agreeing for this, I've already bargained for insurance payment and freight payment. So when I go for overseas buyer quoting $14, I'm getting $14 into the country. That is not only beneficial to the country in getting $4 more, but also to the exporter because each dollar is 82 rupees, 85 rupees. So as an exporter, I'll be always looking at CIF basis so that I can bargain for insurance and freight in India and I can load that with something more extra to the overseas buyer. But buyer also is equally smart. Now, buyer has an agent in India itself to cover insurance, to cover freight. So he will say, I will go for X works because I have necessary enablers in India who can bargain on my behalf and quote, get competitive price. So all depends on the agreements between the exporter and the buyer. But as a layman, CIF is better for exporter. FOB is better for importer.
Yeah.
As a layman.
You have any questions, sir?
I have a question for you. Slightly more complicated than the previous question.
ಇಲ್ಲ ಇದು ಅರ್ಥ ಆಯ್ತಲ್ವಾ sir? Just I thought you are able to.
Because I'm basically an importer. We have imports from Europe and China.
Okay.
So generally, this is the confusion what we have.
Okay. When you go for CIF, they will be charging heavily. When you say you cover insurance and freight, they cover in euros and they load you the euro amount here. So every euro costs you 85, 86 rupees.
Correct.
Yes.
Okay. So taking forward the question from where he has stopped. So pre-pandemic, life was perfect. We are all on FOBs. So we work with the customers in the US.
Okay.
My exporters, we basically are a service provider. We are a sourcing company. So we used to our exporters used to send it out on an FOB basis. The rest, everything was managed by the end customer. Today, post-pandemic, with all the mess in the supply chain, with the container availability, logistics cost, and most importantly, major shortage of labor at the other end, people are now asking us, we do not want to take the responsibility of managing the imports here. We're going to start delivering towards DDPs. And we have a very strange arrangement is that we have an office in the US. India is a cost center. The payment terms what we have with our customers is anything between 45 to 60 days. Whereas our payment commitment to our vendors is 30 days. So we have a gap between the payment time, wherein we are actually raising some funds in the US to make good for the payments in India. Now, beginning of this thing, the previous thing you mentioned about interest capitalization. So now we have a situation
Interest capitalization.
Interest capitalization. So we have a situation where we are paying interest even in the US and also in India. What sort of a mechanism is there that we could ideally manage this?
What is the goods you are exporting?
We are everything into apparels, textiles, soft goods.
Apparels is eligible for interest equalization. So are you availing packing credit from the bank?
Yeah, packing credit. Actually, we are a sourcing company. So what's happening is it's the exporter who's availing the packing credit.
Okay.
So you mentioned about MSME. So they're availing at the time of show.
So you are the actual exporter, but you are getting goods from the sub-supplier.
Correct.
Or you are the sub-supplier.
We are just a go-between. So we have the office in US, which does the entire marketing and the front-end management.
Okay.
Because of the payment differentials dates that we have, so we are paying out from our funds in the US, and our invoices are all raised on us in the US. Because we are managing the last mile delivery to the customers.
Okay. So shipping bill is in your name.
Shipping bill is in our company, US company name.
No, you are exporting, no, in India, from India.
Now, we are a cost center. We manage everything. For example, my vendor, he exports it to my company in the US.
Okay, then you will not be eligible for interest equalization because shipping bill is in the name of your other person.
Other person.
So he is the exporter. Shipping bill says shipper is ABC. ABC can claim interest equalization benefit provided he has taken finance in Indian rupees, packing credit in Indian rupees, post shipment credit in Indian rupees. But here, tell me one thing. You said you are raising funds at US, but is not the risk involved there, exchange fluctuation risk as well as the interest rate risk?
That has been factored into because we have business relationships with these customers for the last 12, 14 years.
I think this should be a good model in that case. Since you have already factored that interest fluctuation risk and the exchange fluctuation risk, this is a good model.
But is there a possibility that we could negotiate for sharing this equalization?
No, that depends out of the account. You can speak to the customer. You tell him that since you are taking rupee credit from the bank, you are benefited with 3% or 2%, whatever it is. Can we share on that? This is outside the guidelines. You can.
It's commercial negotiation.
Yeah, it's a commercial negotiation.
Murli, anything?
Nothing from.
Sir, one small point. According to the law, the liaison offices, the funds have to come from abroad and it is to be routed through the liaison office bank account and the expenditure has to be made. There is a peculiar situation where the head office directly makes a payroll or payment to an outside, to the employees through some other channel without routing it through a bank account. Is it the head office, instead of routing it through the bank account of the liaison office, they do it to a third party agent directly? Okay, can they do it? And if so, because the approval from the Reserve Bank very clearly says all the monies have to come to the liaison office bank account and then the payment made.
Yes.
Now, when they are circumventing that,
but how they are doing, how they are making,
they'll make to the vendors directly.
No, in the sense, see, there are what is called as online payment gateway service providers. So that is permissible. Wherever the remittance is coming to the employee's accounts through online payment gateway service providers.
So to an agency.
No, through an agency in India or overseas?
In India.
HR consulting company.
HR consulting company.
They give the money to them and they in turn.
That is permissible because HR consulting company has an account with the bank.
Okay.
In India.
Correct.
So the overseas employer, he is remitting funds to the HR consulting company. They get into their EFC account or into their rupee account.
Okay.
They in turn send RTGS or NEFT. That is permitted.
But how are you going to monitor the funds? Because
Expenditure of license office.
Yeah.
Okay, but as a license office, they would have permitted this mechanism, because when overseas company has a license office in India, they would have told license office that salaries will be paid through that channel. We need to see.
But is that allowed is my point. Because as I see in the RBI circular, it's very clear, says any expenditure should be through the license office bank account only.
No, but here you
And
are.
that is not appearing in your books of accounts also.
Yes, and it doesn't reflect in our books of account. If the salary will be zero.
Yeah,
Okay,
absolutely.
but whether license office has employed these people,
Yes, yes, yes.
then they have to receive the payment. If license office has employed the people,
Yes, they have
for
employed
whom salary is coming from through an outsourcing agency, that is incorrect. Maybe that might not have been disclosed to the banks, because when bank receives the inward remittance, the other bank, when they receive the inward remittance as outsourcing company, bank will ask them what is the purpose of this remittance. They would have told either service exports or something. We are not sure as to what is the declaration. If they say that this is for payment of salaries to the employees who are employed by license office, bank will not allow it to be created.
With the AD being the, earlier Reserve Bank of India used to directly deal for the license office. Now they have
Now
routed
it is
to AD.
AD. Yes,
And
yes.
I think somewhere seriousness is lost.
No, but here it may be a problem if they have to point out, let the license office take up with that particular HR consulting company, which is receiving the salaries, on what context they are receiving this.
Or they're disclosing the receipt of money.
Ma'am, are there any other questions there?
One more
I
question.
have one question. Myself,
Yes.
Sandeep Parvatikar. Can I take loan from my customer from Australia?
What is it? Can I?
From
Take a loan from my customer at Australia.
Can I take a loan from my
No, no,
customer?
Is the customer equity holder in your company?
No.
And who is the customer? Is it a company or is it a?
Is it a company? That is a company. That is your company.
No, which
A
company is
manufacturer
that? Do they have any interest in your company?
Yeah,
Interest.
we are only supplier to them for a
No.
components. They fully depend on us.
No, for a ECB, it comes under external commercial borrowings. For ECB, RBI has defined who are the recognized lenders.
Yeah.
Overseas financial institutions, overseas banks, supplier of equipment. Suppose if you say your company overseas, if he is supplying equipment to your company in India, that equipment can be in the form of ECB. Otherwise, you cannot take a loan.
You can take a loan from a customer's bank.
Bank you can take, yeah.
Customer's bank, and through their relationship, you can leverage.
Yeah.
Oh,
the
very
interest
good,
of-
very good point. Very good point here. Thank you, sir. Thank you very much.
There's one more question from Mr. Manjunath. Whether the audit of books of accounts of foreign subsidiary is mandatory for the purpose of filing APR as per the recent regulations is issued for the year 21-22.
So here, there are some countries. That is, his question is, I have a subsidiary overseas. As a company in India, I have a subsidiary overseas. So whether auditing of that subsidiary's books of accounts is mandatory. There are certain countries who are not making it mandatory for auditing of books overseas. So when I answer your question, it is no. Auditing of subsidiaries books overseas is not mandatory as long as the overseas country has not mandated it. That is first point. Second point is, wherever the subsidiaries books are not audited, and if the APR has to be submitted by the company in India, the company's board has to permit. The company's board has to take on account the unaudited financials of the overseas subsidiary, and the company's board should record it, that I have taken the concurrence of these financial statements not getting audited. And that certificate should be submitted to the bank while submitting the APRs. So there are both yes and no to his question. I think ask him whether it's clarified. Are you clear? Who was the one who asked the question?
Manjunath.
Yes, Manjunath, did you get the clarity?
Is he muted, ma'am?
No, they have to unmute. So they have to unmute.
That's okay.
Okay, fine. Let's see. Anybody else have any questions? So that I think we have right on.
Yeah,
Thank you.
slightly overshot.
No. We started 5 minutes later.
5 minutes later.
I think if you have no other.
No, these questions most
Yeah,
of it I have
is
answered.
covered.
Okay.
That's what I was saying. It's covered it.
So
Maybe you can move. to
yeah.
the-
So I think we will, after a very knowledgeable session, I would say, I would now request Mr. Ganesh Shenoy, our co-chairman, to sum up the proceedings of today's meeting and also propose a hearty vote of thanks.
Yeah. So thank you so much for this invigorating and energizing session, really. It's really come at the right time, I would say. Now, why am I saying this? Because I think this is really the decade of India on the world stage. We've heard this from many banks, many research institutions. India is the fastest growing economy now in the world. And more importantly, it's a confident and self-reliant India. We've seen that on all world forums. It's really one where India is, it's really the fifth largest economy in the world now. And I think some of the investment related schemes that the government of India has introduced, like PLI, for instance, of course, it has a lead time, but it will have a very strong trickle down impact, in the economy. And I think what it does, it really kickstart the export stream, for the country, the economy as a whole. And international trade finance, I think, will play a big role in really financing this growth. And we heard in this session, thanks to Mr. Somasekhar and Mr. Radhakrishnan, both on the capital account, your capacities can be expanded by way of this external commercial borrowing, the FDI, and even ODI in terms of capacity creation overseas. And some of these financing avenues, I think you will really have to partner with your banks, because as you have heard from both of them, it is also fraught with a lot of policy guidelines, processes. And I'm sure the government will also ease this in the near future. But I think you should really partner with your banks. And there is definitely a benefit because if you really look at it in terms of financing domestically and financing from overseas financing sources, I'm sure there is a benefit. You'll have to really partner with your bank. And the second one is even your current account in terms of financing your working capital. There are enough avenues where you can really benefit, and that will really kickstart your business. And it's very important to really plug into this export revenue stream, so that you really gain overall. And the second is we've also heard the documentation, the policies, processes are not just complex, they are also a little rigorous. They are also time, dependent. So there are some time limits. So again, I think the partnership with the banks is very important. I think you should really start talking to your banks, for some of these opportunities that you have in really growing your business. And last but not the least, the INR settlement mechanisms are very attractive. I myself didn't know that there are now many countries. I thought it was only Russia, but there are many more countries now that are opening up for this. But be very conscious of 2 or 3 things, because if you have an import stream, there is a natural hedge. So don't run into an INR settlement straight away. There are certain other things which you'll have to bear in mind. So again, the partnership with the bank becomes important. And last but not the least, thank you so much for such a comprehensive review of international trade finance, Mr. Somasekhar and Mr. Radhakrishnan, and to you, Mr. Ravi, to anchor this session, and to you, Mr. Kamalakumari and Sachin, for having supported your team, at the back end. And as a gesture of our gratitude, we would like to hand over a small token as a memento for this. And thank you so much for all the participants. I think, through your questions, you really made this session very enriching. And thank you for the other committee members and other leaders of BCIC who attended this. Thank you for your patience, and thank you so much for participating on
South Indian Bank. Also, I'd like to express my thanks to BCIC for giving this wonderful opportunity.
Yeah. Yeah.
So as a token of keeping your money plan to the bankers.
I like this very much. This grows. I'm not, because wherever I go, when I'm getting this, I'm ensuring that this is at least there for 3 years.
Madam, yes, yeah. Please come, man. Sajid, come, join us. Okay.